Welcome to TalkTickers. We're your hosts, diving deep into the latest earnings calls.
Today, it's all about CrowdStrike. Their fiscal second quarter 2026 results just dropped, and the market reaction was definitely interesting.
Yeah, our mission, as always, is to slice through the noise, pull out the key insights, and basically help you get up to speed fast.
And this CrowdStrike call, it's a fascinating one. You've got really strong performance in the quarter.
Right, some record numbers even.
Exactly. But then looking ahead, there's this layer of caution that seemed to really grab the market's attention.
It really did. It's that classic forward-looking view investors take, isn't it? But let's not skip over Q2 because those numbers were, well, pretty robust.
Oh, absolutely. Let's hit that snapshot first. Non-GAAP EPS, 0.93 cents. That beat the consensus estimates by a good 10 cents.
10 cents is pretty significant. And revenue also beat.
Yep, came in at $1.17 billion, also ahead of expectations. And that's a solid 21% growth year over year.
Okay, and for a subscription business like CrowdStrike, ARR is key. How'd that look?
Annual recurring revenue grew 20% year over year, reached $4.66 billion. So definitely showing a solid expanding base there.
But the net new ARR, that's often the number people watch closely quarter to quarter.
And that's where they really shone this quarter. Hit a record $221.1 million. That was double-digit millions, better than the street expected. Really strong.
Wow, okay. Operationally sound, too. Margins, cash flow.
Very much so.
Sure.
Non-GAAP subscription gross margin held steady at a strong 80%.
That's impressive.
It is. And free cash flow, another record, $284 million, which is about 24% of their revenue, plus their cash pile grew to a record $4.97 billion. So financially, very healthy.
You'd think fireworks, right, with numbers like that?
You would. But like we said, despite how good Q2 looked on paper, the initial market feeling after the call was, well, cautious is the word.
Investors just seem to pivot really quickly from looking at Q2 to worrying about the guidance.
That's pretty much the story of this call, yeah. Strong results, proving the business is executing, but then immediate focus on what's coming next.
Okay, let's unpack that then. Because management, they didn't sound cautious, did they? They came out with this big theme, reacceleration.
They really did. That was the core message. They explicitly said reacceleration a quarter ahead of expectations, specifically in that net new ARR growth.
And they linked it to something specific.
Yeah, directly to what they called AI-necessitated demand for the Falcon platform.
Yeah.
And, just generally strong execution. It's clear AI is now central to their story.
How so? Like both sides of it?
Exactly. Both the threat AI making bad actors faster and the solution AI needed to defend against those threats and secure AI systems themselves. It feels pretty fundamental to their strategy now.
So this AI-necessitated demand, how's that showing up in their platform strategy? Are customers actually consolidating more onto Falcon?
The data suggests they absolutely are. Falcon is being pushed as the operating system for cybersecurity, not just another tool.
And the adoption numbers back that up.
They do. Get this. 48% of subscription customers are using 6 or more modules now.
6 or more. Okay.
And for the bigger customers, those spending over $100 in ARR, 60% of them are using 8 or more modules. That shows really deep integration. Customers are going all in.
And wasn't there something about a specific licensing model driving this? Falcon Flex?
Ah, yes, Falcon Flex. That's been a huge success. They've blown past 1,000 Flex customers now, added over 220 just this past quarter.
Wow.
And what's really interesting is the reflex motion. Existing Flex customers adding more modules, that activity more than doubled in Q2.
And did that translate into more revenue from those customers?
Significantly. On average, those reflexing customers boosted their ARR by almost 50% within just 5 months. It shows the platform's power to expand once a customer's in.
Okay, sticking with AI, what about their own AI tool, Charlotte AI? We've heard about that before. Any updates?
Yeah, Charlotte AI, their sort of AI SOC analyst, it saw growth over 85% compared to Q1.
85%. That's huge, quarter over quarter growth.
It is. It's automating workflows, cutting down investigation times. The SOC, the Security Operations Center, is crucial. And Charlotte AI is clearly a big part of making that more efficient.
So beyond the core endpoint stuff and AI, they're also pushing into other areas, right? Like identity, cloud security.
Definitely expanding their footprint. Their next-gen identity protection business, that's now over $435 million in ending ARR, growing nicely at over 21% year over year.
And what's new there?
Well, crucially, it now covers non-human identities. Think APIs, service accounts, plus SaaS apps, even AI agents via something called Falcon Shield.
Non-human identities, that feels increasingly important.
Absolutely. And they also launched a new privileged access management, or PAM, offering in Q1. PAM controls high-level access, and they're aiming to disrupt older solutions there.
Makes sense. And the cloud security part.
Big growth there, too. Total cloud ending ARR topped $700 million. That's growing over 35% year over year. They emphasize runtime protection, securing apps while they're actually running.
And exposure management, that was another one.
Yep, across $300 million in ending ARR. And they got named a leader in the 2025 IDC MarketScape for it. So yeah, hitting on multiple cylinders across these growth areas.
It really sounds like they're cementing their position. What about outside validation, like Gartner, partnerships?
Still getting strong marks. Gartner put them in the leaders box for endpoint protection platforms again. That's 6 years running now.
Yeah.
Speaks to consistency.
And partners, are they bringing in business?
A lot of it. Over 60% of new business came through partners in Q2. Some big wins mentioned too.
Like what?
Red Canary, migrating over 100,000 endpoints to Falcon. Amazon Business Prime, picking Falcon Go for small businesses. And a really interesting one with Nvidia.
Nvidia, what's the connection?
They're using Falcon Cloud Security to protect the AI lifecycle for over 100,000 of Nvidia's large language models. That's a huge AI security validation.
Okay, that Nvidia partnership is definitely noteworthy. But amidst all this growth and module adoption, there was one really big strategic move announced, wasn't there? An acquisition.
Yes, that definitely caught my attention. They announced they're buying a company called Onum.
Onum, what do they do?
They're a real-time telemetry pipeline platform. And CrowdStrike's goal here is explicit, to supercharge Falcon Next-Gen SIEM.
SIEM, okay, security information and event management. How does Onum supercharge it?
They're claiming it will allow Falcon SIEM to handle 5 times more events per second than the nearest competitor and cut data storage costs by half. Those are big claims.
5 times? How?
It seems to be about this concept of in-pipeline detection. Analyzing data for threats as it's flowing in, even before it lands in the SIEM storage.
Ah, like checking IDs at the gate, not waiting till everyone's inside.
Exactly. It's an architectural advantage, potentially much faster. And Falcon Next-Gen SIEM itself is already growing like crazy, over 95% year over year, past $430 million in ending AR.
Why such fast growth there?
Part of it's their pricing model. They don't charge customers for the data CrowdStrike itself generates, which is a big differentiator from older SIEMs that often sting you on data volume. The Onum deal looks set to amplify that disruption.
Makes sense. Now, you mentioned AI earlier. They also talked about AI as a threat, right? Not just something to secure.
Yes, they highlighted that double-edged sword, how AI helps defenders but also speeds up adversaries.
Any specific examples?
They cited intelligence on a North Korean group, famous Cholima, using generative AI, apparently automating things like faking resumes, even doing deepfake interviews to infiltrate organizations.
Wow, that's sobering.
It is. And CrowdStrike's response, their pitch, is that they secure AI at every layer.
Yeah.
Model, workloads, identities, devices. And they stressed, interestingly, that AI security isn't fundamentally a network problem.
Not a network problem. What is it then?
They argue it's primarily an endpoint and cloud problem, which naturally plays right into Falcon's strengths.
Okay, so strong Q2, record net new ARR, strategic acquisition, clear AI focus. Brings us back to the guidance. Why the caution? What exactly did they guide?
Right. This is where the market tapped the brakes. For Q3, revenue guidance was $1.208 to $1.218 billion. That was just a touch below what analysts expected.
Just a touch below, okay.
Yeah.
And for the full year?
Full year FY26 revenue projected between $4.7495 and $4.8055 billion. Also maybe implying a slightly more measured second half than some hope for on the top line.
But didn't you say EPS guidance was actually okay?
Better than, okay, yeah. Q3 non-GAAP EPS guided to 93 cents or $2.95. That was above consensus. And the full year, $3.60, $3.72 was also strong. So profit outlook good. Near-term revenue, bit soft, mixed signals.
What about ARR guidance, though, if they're reaccelerating?
See, that's where their conviction really showed. Management explicitly projected at least 40% net new ARR growth in the second half of FY26.
At least 40%. That sounds pretty bullish.
It does. And they expect to blow past the $5 billion ending ARR mark by year end. So the underlying business momentum, the ARR engine, they seem very confident in that.
So why the disconnect? Why the softer near-term revenue guidance if ARR is set to grow so strongly? Was there a specific reason?
There was. A big one. The lingering financial impact of that Windows outage back on July 19th.
Ah, right. The outage. How did that affect the numbers?
Well, it hit him for $35.7 million in expenses in Q2. And they're expecting another $51 million in cash payments in Q3 related to costs from that.
51 million in Q3. That's significant.
It is. They rolled out these customer care packages, CCPs, and partner programs to keep customers happy and maintain retention after the outage. Management basically framed it as a necessary temporary investment in loyalty.
So spending money now to keep customers long-term, even if it dings near-term revenue recognition.
That seems to be the calculation. They expect these extra costs to mostly fade starting in Q4. Oh, and one other small guidance point. They cut their long-term non-GAAP tax rate slightly to 21% from 22.5%. That helps future earnings a bit.
Okay, so putting it all together for investors. Strong Q2 ops, record net new ARR, good profit guidance, strong ARR growth guidance. But softer near-term revenue guidance due to these outage costs.
That's the picture. And the market's immediate reaction, a 6-8% drop after hours, a classic beat the quarter but guide light reaction, even though the ARR story sounds strong.
So investors focus squarely on that Q3 revenue miss and the outage costs.
It really looks like it.
Yeah.
They seemingly weighed that near-term revenue drag more heavily than the Q2 strength, the Onum deal, and management's confidence in that second half ARR reacceleration. Short-term pain versus long-term gain, and the market chose to focus on the pain initially.
How does this position CrowdStrike in the cybersecurity landscape right now? Budgets are still strong, right?
Budgets are prioritized, definitely. But companies are getting more selective. They want consolidation. Fewer vendors, more integration.
Which plays right into CrowdStrike's platform message.
Exactly. That's a major tailwind for them. The AI security narrative, too. But these temporary headwinds, the outage costs, maybe some related pricing pressure or incentives, they're creating this near-term noise that the market is reacting to.
And financially, they can weather this, that cash balance.
Nearly $5 billion in cash.
Yeah.
Yeah, they have a fortress balance sheet, plenty of cushion. And their M&A strategy, like with Onum, seems focused on tech integration, not just buying revenue, which is generally seen as smart.
Okay, so looking ahead, what are the key things investors should watch? What are the catalysts that could change this narrative?
Well, number one is execution on Onum. Can they integrate it quickly and show real results in that SIEM pipeline?
Delivering on that 5x events promise.
Or something close to it, yeah. Number two, delivering on that at least 40% net new ARR growth in the second half. They set the bar, now they need to clear it.
And number three,
seeing those outage-related costs and any associated discounting actually normalize, probably starting Q4 like they guided. If those things happen, the narrative could shift back towards the underlying strength.
it's interesting, the stock's had a great run over the past year, right? Up 60%.
Hugely outperformed. But this recent dip just highlights that tension into strong fundamentals versus these near-term revenue recognition issues. Resolving that tension is key now.
All right, let's shift gears a bit. Considering this whole picture, the beat, the cautious guide, the pullback, how might a particularly bold investor, someone looking for an edge, think about playing this?
This is not financial advice segment. Outrageous but plausible trade ideas.
Okay, so remember, this is purely hypothetical, exploring angles, not actual advice. We've got this classic beat and lower scenario, right?
Right.
Markets fixated on Q3 revenue and that $51 million outage hit.
Right. What might they be missing or underweighting in that reaction?
Maybe the sheer conviction behind that 40% plus net new ARR growth target for the second half, the fact they delivered record net new ARR now, and the strategic potential of Onum, which could be a real game changer for their SIEM business long term. So you could argue the reaction is overblown due to temporary issues.
Okay, so based on that, trade idea number one.
Trade idea one, the AI infrastructure bull play. The idea here is straightforwardly bullish, but using options for leverage. Think about buying CRWD call options, maybe with a $450 strike price expiring about 6 months out.
So betting the stock recovers and pushes well past $450 within half a year.
Exactly. The rationale is that the market is undervaluing the AI tailwind and Onum's potential. Management said AI-necessitated demand is driving things. Onum boosting the SIEM gives them a serious edge in data security. It's not just cyber, it's securing the whole AI boom.
And if they hit that 40% plus ARR growth and show Onum working,
the market could quickly re-rate the stock. The dip provides, arguably, a better entry point for that medium-term bet. 6 months gives time for those catalysts to play out.
okay, that's the medium-term bull case. What about something playing the immediate reaction?
Trade idea two. The short-term sentiment arbitrage. This one's definitely higher risk, more complex. It involves playing both sides. Start with the short-term put spread, then pivot to longer-dated calls.
Whoa. Okay, break that down. Put spread first.
Yeah, the idea is the initial negative reaction might push the stock down further in the very near term, maybe the next few days or week. So initiate a bearish put spread for maybe 1-2 weeks out to try and capture that sentiment-driven dip. It's a defined risk way to bet on short-term downside.
Okay, so capitalize on the immediate negativity. Then what?
Then, as the dust settles, assuming the stock finds a floor and investors start digesting the stronger parts of the story, the reacceleration, the record ARR, Onum, you pivot. You look to simultaneously buy longer dated, out-of-the-money calls for maybe Q4 FY26.
Out of the money, like maybe $460, $480 strikes, expiring end of year or early next.
Something like that, yeah. Think December 2025, January 2026. This positions you for the potential recovery and rally as the market looks past the outage costs and focuses back on that 40% plus ARR growth and the bigger picture.
So using the dip caused by short-term sentiment as a launchpad for a longer-term bullish bet. Arbitraging sentiment versus fundamentals.
Precisely. It's definitely a more active, higher risk approach trying to time the sentiment shift, but plausible if you believe the initial reaction was overdone.
Got it. So two very different ways a build investor might look at this setup.
Right. So just to wrap things up, CrowdStrike's Q2, operationally very strong. Record numbers, reacceleration kicking in sooner than expected, fueled by AI demand, plus the strategic Onum buy.
The market reaction was muted, even negative, because the near-term revenue outlook was softer than hoped, largely due to those significant costs stemming from the July Windows outage.
Exactly. Management, however, sounds really confident about the second half, projecting significant ARR growth to continue.
So it creates this real tension, doesn't it? Immediate market worries versus the company's longer-term strategic execution, especially in this fast-moving AI security space.
It really does. And how the market balances those two things, the short-term noise against the long-term AI opportunity and threat, that's the big question going forward. Definitely one to watch.
Absolutely. Okay, just a reminder for everyone listening, this deep dive, including those trade ideas, is purely for informational purposes.
Yeah, it's definitely not financial advice. Please, always do your own research, understand the risks involved, and maybe talk to a qualified financial advisor before making any investment decisions.
Thanks for tuning in to TalkTickers. Join us next time as we unpack another earnings call and the market moves around it. Send us your feedback and questions.